Well, the latest craze to hit the stock market is special purpose acquisition companies, or blank check IPOs. Some of the big ones are Virgin Galactic, DraftKings, and Nikola. And joining me today to break down everything that you need to know about this new way of investing is Matt Krantz. He is IBD's management and personal finance editor. Thanks for joining me today, Matt.
Thanks for having me.
All right, so first off, for the uninitiated, what exactly is a SPAC or one of these blank check IPOs, and how are they different from traditional IPOs?
That's the question everybody's asking, so you're right on the money. The SPAC, the Special Purpose Acquisition Company, is another way for companies to go public. So we all know about the traditional IPO, where companies sell themselves to the underwriters, and the underwriters bring them public in a big splashy debut. This is just another way of pulling this off, but it turns it on its head. So rather than taking the company public right away and you buying into shares of the company, what happens is you're giving your money to a sponsor. And this sponsor has 2 years to go shopping with your money to find a great deal. And you have the right, when they come up with a deal, to either decline it or to accept it. And it's at that point that the company goes public. So it's turned on its head. Rather than buying right into the company, you're putting your money into a cash reserve, which is then used by a company to go shopping and bring the company into the public shell. So the companies have 3 ways to go public. They can use the traditional IPO, which we just talked about, the SPAC, which we talked about, or they can do a direct listing. The direct listing is a method to go public when a company can't raise additional money. They're not allowed to raise additional funds. So they have 3 choices. The traditional IPO is fine, except the underwriters take a big fee of the deal, and there's a lot of uncertainty. Just ask the poor people at WeWork when they tried to go public last year, and all the dog and pony shows and all the underwriting and all the scrutiny found that that business model was a little shaky. That deal never happened, and it left the investors, the private investors, with big losses. The direct listing is great if you're Spotify or if you're Slack, and you don't need the money. You're so well funded, you're in good shape financially, your business model is sound. You don't need to raise money, that's great too. But there's a lot of companies that don't fit those 2 doors. They need to raise money, sometimes a lot of money. Some of them aren't even revenue positive. If you look at Nikola, the electric truck maker, they don't have revenue. At the same time, you don't want to subject yourself to the whims of the stock market. If you're going the traditional IPO route, if the market gets cold like it did in March of this year, you're out cold and you don't have any money. So it's a great option, but it's not going to replace the IPO. It's going to go along with it, but man, it's coming on strong. There's so many SPAC deals this year. They're setting new records. They're blasting past where they were last year, and they're now rivaling the number of traditional IPOs, which is why everyone's so excited about them.
Yeah, well, what do you think is exactly behind the excitement and intrigue of this versus doing that traditional listing?
So I'm going to be real careful when I talk about this because it's a little tricky. These SPACs have a 2-pronged strategy. When you first buy the SPAC IPO, you put your money in the hands of the sponsor. The sponsor basically puts your money into a cash reserve and pays you interest. So if you think about that, you're basically putting your money away and you're guaranteed you can take it out at any time if you get out before a deal is made. So it's kind of like a bank. It's like a bond. It's like a pretty safe investment with an equity kicker, because here's the fun part. You give the money to someone, they shop around, they find an amazing deal. They've got the money, they do the deal. You're on the ground floor of this new company while you took no risk to get there. That's what people like about them. They like the fact that you can get a yield at the upfront and you have an equity kicker that exposes you to potential upside.
Well, in the traditional private equity market, a lot of places, there's a minimum threshold for investors in the amount of money they need to fork over. Is this different? Who all can buy into one of these before they actually go public?
Another great question. So in private equity, it's kind of a club. It's pretty clubby. You have to be accredited. You have to have a certain amount of assets. There's not much diversification. It's kind of an inside game. The SPAC is a great point that you bring up, opens it up a little bit. So you don't have to put your whole net worth into one private equity deal. You can spread it around in a couple SPACs. Some may work out, some may not, but you can spread it out and it's open to everybody.
And so with that, then what are the risks that investors out there need to be aware of with something like this throughout the various stages of the process?
So that is a good point. So they've changed SPACs quite a big deal here in the last 10 years or so. The big change now is you can still vote for a deal, but you can get your money out. You can basically get out of these things. The risk, though, is you have to pay attention because there's a cutoff. And if the person that you gave your money to finds a deal that you don't like, you only have a couple days to get out. So if you're on vacation and one of these deals goes out and buys the Ringling Brothers Circus, and you don't like that deal, and you were away, guess what? You're now in the circus business. So this is not, we cannot stress that enough. This is not for passive investors. If you like S&P 500 and QQQ and buy and forget and set and hold, this is not for you. You need to monitor these constantly.
So then you mentioned there's an equity kicker type aspect of this once we do see the companies go public. So let's take Nikola, for example. And with some of these, we've seen, even Virgin Galactic, we've seen a lot of volatility with those names. So how should investors be thinking about once that company does go public? How should they be thinking about that investment? It sounds like it is geared towards a little bit more of an active trader or someone who at the very least is willing to take on a little bit more risk tolerance.
Absolutely. And there's something that's kind of cool about these SPACs that takes some of the guesswork out of it. They start trading usually at $10 a share, and they trade around $10 a share while the sponsor goes looking for a deal. The minute they find a deal, investors immediately react to it. So if you see the deal drop below $10 a share, that tells you that the other people that are in this pool with you don't like it. And that should be a red flag to you. They could be wrong, but there's a lot of smart money in these things and they are betting against it. With that said, if they rise above the $10 share, the market likes it, or there's something about it that they like, and you might want to stick around. But with that said, you bring up a great point. As soon as it crosses the Rubicon and it becomes a stock and that equity kicker kicks in, you're on. I mean, this is a full-on stock now. There's no money back. There's no guarantee. You're on your own. So when that day comes, you need to not only know it's there, you need to make your decision, and then you need to know that at that point on, you have a risky company. And keep in mind, these are companies that did not go through the traditional IPO process. They were not vetted like these other companies were, and they need money. So it's kind of, when you pick this door number 2, the SPAC door, it kind of indicates a kind of a riskiness that you're not getting with some of the other deals.
Well, definitely a lot for investors to digest, but it's a very exciting area and it sounds like one with a lot of potential. So thank you so much for helping us dissect the ins and outs of SPACs today, Matt.
Oh, thank you.